Hi, welcome to Cambia Grove's Lunch and Learn. For those just joining, we will begin in just a few moments. So just get settled. Hopefully you can see the screen, the Lunch and Learn screen. Welcome to Cambia Grove's Lunch and Learn today. We will begin in just a few moments. Looks like we've got almost 30 people signed on. We'll give folks just another moment or two before we begin. Welcome to Cambia Grove's Lunch and Learn. We will be starting in just a moment. We'll wait for a few more people to join on the call today. Okay, we will get ready to start. It's 12:32 Mountain Standard Time. I'm in Utah. And we've got East Coast and West Coast, and I'm sure we have the Midwest on the line today. I'm Elizabeth with Cambia Grove. We are a healthcare innovation hub working to help transform the healthcare system to be person-focused and financially sustainable. I am delighted to welcome you to our virtual Lunch and Learn. It's a partnership with Echo Health Ventures and a series that we bring experts from the field to work and share their knowledge, experience with folks that are innovating in healthcare. So I'm delighted that we have Kurt Scheelein with Echo Health Ventures. He's a principal. And we will be talking today about what to 409A valuations. We were pleasantly surprised by the turnout with over 90 folks registering for this Lunch and Learn today. And it's a special pleasure to connect with the MFA companies, a business consultant and financial advisory firm that's working globally and is headquartered back in Massachusetts. I'd like to give a shout out to my high school buddy, Bo O'Connell, for making this connection with the MFA companies. And we get to hear today from Gregg Hamilton-Piercy, who is a partner with the MFA companies. So today, just a few housekeeping before we get started. Each of you will be muted and your screen will be turned off. So if you are having lunch or coffee, don't worry about being on the screen. The format will be a 30-minute discussion with Gregg and Kurt. Kurt will be moderating, but will also be sharing his expertise as in venture in healthcare as part of this discussion and his experience with 409A valuations. They will do a brief introduction of themselves and their companies, and then we'll turn over to a 30-minute discussion. We will do 15 minutes of questions after that, and we want you to think about questions as the discussion happens. So in the right side of your screen in the chat box, if you can just enter any questions that you have, and we will take those after we hear from Gregg and Kurt. So I'm going to go ahead and turn the time over to Kurt and Gregg, and thanks again for joining us today.
Thanks, Elizabeth, and just want to make sure you can hear me. Just a quick check there.
I can. This is Gregg.
Okay, yep. Perfect. Thanks, Gregg or Elizabeth. Thanks for the kind introduction, Elizabeth. Again, my name's Kurt Scheelein, a principal at Echo Health Ventures. We are a healthcare-focused investment firm with 4 offices across the country. two in the Pacific Northwest, in Seattle and Portland, and then Boston, and then in Durham, North Carolina. We are a joint venture between Cambia Health Solutions, which is a holding company for 4 Blues plans in the Pacific Northwest, and then Blue Cross North Carolina on the East Coast. Goal is to invest in companies that are transformative to the healthcare industry more broadly, and that are also important parts of our parent company's strategic visions for transforming how healthcare is paid for and delivered overall. Have a portfolio of about 25 companies across different stages. Again, healthcare tech and services focused, that we've built over probably about the last 5 or 6 years now. But definitely excited to be doing these lunch and learns in collaboration with the Cambia Grove team, and really excited to bring Gregg in today from MFA companies to talk about valuations, the good, the bad, the dirty, and the ugly, right? And happy to answer your guys' questions as well around all of the intricacies that goes into determining a valuation and what some of the implications are around setting a valuation. So that's us in a nutshell. And Gregg, maybe if you could give a quick background on yourself and what you do at MFA, and then we can just jump right into discussing valuations.
Sure, thanks, Kurt. So welcome everybody. Thanks for taking some time out of your schedules to sit with us today. I'm a partner. I'm the lead partner of our valuation and financial analysis consulting practice at MFA Companies. We're about a 200-person full-service consulting firm relating mostly to finance and accounting type areas. I spearhead the team that does a lot of the valuation work, all of the valuation work at our firm. We do, for context, for 409As, we probably do about 350 projects a year in that sphere, along with a whole plethora of other valuation-related engagements through valuing intellectual property to complex derivatives, for any number of reasons. So we do a lot, and our backgrounds are kind of the venture investment banking type of sphere. We have a healthy understanding of all things sort of accounting and GAAP related as well. So that's us in a nutshell, and glad to be here today.
Awesome. Well, I guess we'll just jump right into it, Gregg. I think, valuation, it's a pretty loaded term, right? And a very detailed term at that, right? Lots can go into it. Valuations are often used for numerous different purposes. Can you talk just a little bit about, what makes determining a valuation so hard? Why is it such a complicated endeavor?
Well, it kind of depends on the parameters, right? I mean, most times you need to conduct a proper valuation, whether it's for an investment or for some sort of IRS reporting purpose or GAAP financial reporting or in a litigation sphere. Understanding purpose is a huge part of how to set the tone for how you approach the project. In this context, there are a couple contexts that you can imagine the listeners would be participating in. A would be in the 409A sphere, which is a colloquial term used to kind of govern valuations associated with equity issued as compensation usually to attract employees or board members for that matter. 409A refers to the IRS code. It's a very specific section in the code, but people use it generally to describe a valuation for equity issued as compensation. It can be decidedly different under a GAAP context or generally accounting principles context, and definitely different in the context of a raising capital kind of investor context. So one of the challenges you have, to answer your question, is defining the right purpose, defining the right date, because dates can be huge, particularly in post-COVID. What things were worth December 31st, 2019 could be very different today, depending on what sector you're in. And really the kind of nebulous concept of valuation is is a healthy mix of good corporate finance, tax rules, and a very healthy amount of kind of artistic elements, subjective elements. So it is challenging, but at its root, regardless of the purpose of the date, valuation is always the same thing. It is a numerator and a denominator. It is a potential benefit stream associated with an investment. So how much you expect to earn on that lifetime of holding that investment, and what is the risk of actually generating that return. Once you've solved that numerator denominator equation, it's fundamentally what valuation is. Now to get to that is a little challenging, pieces to it. But
yeah. And I think what you mentioned there, Greg, around the different uses for valuation, maybe we take that as a good framework to drive a few questions and discussion points further here. So let's start maybe with the investor side, right? Raising external capital or fundraising if you're an entrepreneur. Mm-hmm. In that context, I mean, do you view valuations as being created equal, or are there other complexities that entrepreneurs should be thinking about in addition to valuation as a number?
So there's a couple things to consider there. As it relates to valuation itself, if you are perspective is everything. If you're a founder of an organization, you've got your blood, sweat, and tears. You identify almost as one and the same as that company. It is your baby. You've got an inherent bias in terms of what true value might be in that enterprise. Not the least that it's a job at the same time as a project that you're building, a company. On the flip side, if you're an investor, this could be the first of many investments in your company. It could be the first of investment in a specific industry. It could be what you might construe to be a bolt-on investment where you've already got a platform like Echo. Echo's got 25 or so portfolio companies, investments that they've already got. And if you see a sort of synergistic type of benefit in investing in your enterprise, your baby, very differently because they've got what you might call synergistic benefits associated with their investment thesis. So perspective is huge. If you're on the investment side, you're thinking on how much can I get out of this investment after I've invested? How much work do I need to babysit this investment? How many rounds do I need to go to keep preserving my first dollar, for example? Because it's not usually one and done. I mean, usually folks on this type of call are looking to kind of change the world at a minimum. At a maximum, a minimum, they're just trying to do some evolutionary change. Either way, there tends to usually be multiple rounds of financing. And so both players need to really keep that in mind, is that this is not the first time we're going to negotiate. Over-promising could be challenging if you're the entrepreneur, because if you don't deliver, it's going to be tough to raise that next round. And then flip side, if you're investing for the first time, understand that you probably have some additional needs that will manifest, a year, 2, 3 years later to keep the thing going. So it's a challenge if you're an eco health venture type, or if you're some sort of venture fund. Those invested in a fund, pick a number, $100 million fund, and the fund's profile was expected to generate 25% internal rate of return. That means that the Echoes of the world need to invest in projects on an average that generate at least 25% rate of return. So if your project is not going to generate that kind of return, if it's on the lower end of that, understand that it's going to be more challenging to raise that capital. On the flip side, it might look a little too aggressive. So it's a careful balance.
And maybe I can just comment a little bit too, Greg, just on some of the things you mentioned there. I do think any capital that is raised into a business, I think, is looking for a return, right? I think the investor is looking for the company to create value, ideally multiples of value on that money. And so whenever the entrepreneur has the decision of whether or not to accept money into the business, I think that's certainly a consideration to think about, right? What am I signing myself up for and ensuring that the investor is aligned with the value creation to the entrepreneur and the common stockholders, right? I think your comment, Greg, also made me just think about, not in my mind, not all valuations are created equal, right? And I think it's a piece of the puzzle ultimately to the end goal of generating value, right? By growing a business and transforming how things are done in an industry. I think there are other pieces to consider in addition to that number that puts the sticker on the company. I think looking at how the capital structure is built and what some of the other terms associated with the shares that are created is an important consideration to make as well. Can you talk maybe just a little bit, Greg, about some other complexities on the capital structure side that you've seen and how
Sure.
they could impact, in an ultimate exit event, how viewed?
So there's an old adage that we have used frequently in my department about, you tell me the value and I'll tell you. And the notion is that pick a number, the company's worth $10 million. Well, that's the subject interest in the capital raise is not the company, to be clear. The subject interest is the newly created preferred share class that you're likely going to be issuing for the investment dollars. How much are those shares worth? Not how much the company is worth. It's a very different concept that a lot of folks don't fully appreciate. And it's fundamentally to your question, Kurt, because a newly created share class often has different bells and whistles that a traditional common share class would have. The proverbial founder, owner-operated enterprise is usually capitalized with a simple ownership structure, capital, common shares that are pretty intuitive. Company's worth $10 million, you've got 10 million shares, each share is worth $1. Publicly, much the same. Most public companies are really capitalized with one share class, common. So the common lexicon in the world is to think of businesses and value per share as kind of one and the same. But the reality is in a venture world, there is the introduction of the proverbial complex capital structure, so the creation of a new class. So to answer your question, the class is that the most common features you'll see in a preferred share class are things like liquidation preference. What that means is if I put $5 million in, when the company sells, I'm getting the first $5 million out. Now that clearly makes a different benefit stream for that owner. If you only sell for $4 million in 5 years, which is not great, guess what? Founder got nothing at that point. They took everything with them on the back end. If you only sell for $7 million, that's not enough for the preferred class to actually convert into a common share class and share evenly with the common shareholders. Guess what? They're getting 5/7 of the value at that point. So when you introduce a complex security, and here's an example on the screen, when you introduce a complex security, you've now converted from what we'll call a linear benefit stream that you typically see with a simple cap table to a non-linear benefit stream for each share class. So if you look on the table on the screen, you've got really two examples. The simple equity structure is a common share class with non-convertible preferred shares you might have in there, and then common options or profits interest if you're an LLC. The introduction of a complex capital structure now means the introduction of potentially convertible preferred shares, convertible debt, common and preferred warrants, and then there might be an introduction of some sort of management carve-out, which isn't explicitly equity, but it is nonetheless, you're moving the benefits away from common in a disproportionate manner with the introduction of any of those sort of light blue complex ownership or claims on equity elements. So it's an important distinction, and it's particularly important because most of the conversation in the capital raising environment focuses on the pre-post money value of the company, when the reality is it needs to be a pre-post money value of either common or preferred or some element of the two to really understand what you're giving up, and to maybe put it in a numerical example. If someone is investing, a certain amount of money, and on a fully diluted basis, they're taking down 15% of your cap table. So let's say you had, 10 million shares after the fact, and they bought 1.5 million. Understand that the existence of those complex features might make it that they're actually entitled to 25% of the economics. So don't get confused with the fully diluted cap table percentage and the actual economic implications of that investment. And it's those nuances that can be really important to focus on, and to some degree get an outsider, your lawyer or whatnot, to help you interpret some of the value components of those features.
Yep. Yeah, and I think, to your point, Greg, I think valuation is a piece of the puzzle, which I may have mentioned already. There are other considerations to make in addition to just that number. Maybe we switch gears just a little bit, Greg, moving beyond that investor lens and starting to think about things from an option and common stock perspective. So more specifically, the 409A piece. Can you talk just a little bit about some of the tactical methodologies that are used to actually get to that valuation number in that context?
Sure. On the next slide, we've got a very small narrative to that effect. Basically, valuation, in a nutshell, is born out of 3 different potential methods. They're buckets of methods. There's an asset approach you can see on the screen: asset approach, market approach, income approach. I'll give you an example of each. An asset approach is really, for lack of a better word, cost to replace. If you've spent $2 million to get where you are, the value of your company is $2 million. And I'm trivializing it entirely. There's a lot more to it to really conduct a formal asset approach, but that's loosely the idea. Not a great method, but sometimes it's the best you got, particularly when you're in like a drug development stage company with like a binary business model. You just don't know, because the moment you get your first read or phase 1 and it's doesn't make any sense, and you close your doors, you've got a zero value. So it's really hard to, pharmaceuticals in particular can be challenging for that reason. They've got a very sort of binary bimodal business model. And sometimes you use asset approach when it's an earlier phase of development. Market approach are things like multiples of EBITDA, or earnings before interest, tax, depreciation, and amortization, a multiple of revenue if you've got it. Those are the more common market approaches, and they can be pulled from private transaction data or public multiples to the extent you've got public company data that's relevant. And then the most common that we tend to use is the income approach, which is the proverbial discounted cash flow. So you spend some time thinking about a forecast: how much revenue are we going to generate, what's our cost structure, and then what are our investments for working capital and so forth. And then you discount that all back to today at a rate that is commensurate with the risk profile, or said differently, the kind of return that an investor is looking for to buy that cash flow that you're projecting. That would be the discount rate you'd use. You do all of those, any one of those methods, either contemporaneously or independently, to value a company. And then from there, as I suggested earlier, once you've figured out the value of the company, you would actually then go one step further to figure out the value of each share class, because it's not a proportionate sharing once you've introduced those additional economic features. And there's a number of ways to do that. So in a 409A context, that tends to be the second step, where most folks are not very seasoned, unless you do it sort of for a living, is to understand all the option pricing methods and current value allocation models and hybrids, and sometimes we do simulation models and whatnot, to actually figure out that allocation of value amongst the different classes.
Yeah, I want to double click on that 409A piece in a minute, Greg, but I guess just from our perspective at Echo, one thing I would mention here just around the importance of getting valuation right, and not always optimizing for the highest valuation you can get. is, I think as you look to raise more capital at a later date, the investor is likely to look at a blend of these different approaches that Greg just went through, right, in relation to how you're thinking about your projections for the business going forward, how you've actually operated the business since you raised capital, right? And making sure that all of those different approaches, when blended together, make sense financially, right? And so we've seen many businesses that end up, getting ahead of their skis from a valuation perspective. So I guess what that would mean is raising a large amount of money at a high valuation, where post that fundraise, they then begin operating that business and spending that money, which again, going back to the start of our conversation, has a return expectation attached to it. And if they are not able to execute from a financial perspective that makes that valuation in line with how the business would be valued on a market approach or an income approach or a blend of those, that's where you could start to see things getting a bit more difficult, right? If you have to go out and raise more capital again. You might have to raise capital at a down round, which would end up being quite dilutive to the management team, or with terms that, again, shift that benefit stream in the future more in the investor's favor than the entrepreneur's favor. So there are lots of considerations to make when you raise capital, and not just optimizing for the highest valuation that you can get. Greg, maybe we switch gears just to the 409A in practice, and kind of what is it used for? What are some of the things that entrepreneurs should be thinking about? I think you had mentioned that 409As are typically used to value stock option grants. What have you seen that could go wrong from that perspective? And obviously, what are some of the best practices that you've seen entrepreneurs make when doing a 409A and thinking about stock option grants?
So it's good questions. One thing to keep in mind is something I said at the onset. Purpose and perspective are everything. The seasoned sort of entrepreneur who may have done, a few rodeos and raised a bunch of capital over the years and done a lot of 409As, they know that, and the IRS, I hope, is not attending this call, but they know that the goal of a 409A is to actually drive value down. That tends to be the desired result, is the lowest value you can come up with. And the reason being is that you use that document to help document or set strike prices on options, the very options you're using to incent your employees that you don't necessarily have $300,000 a year to pay. You're incenting them with low strike price stock options. So the lower those strike prices, the more valuable they are, the more incented your employee is. That type of exercise is decidedly different when you are trying to raise capital, because it's intuitive that you're trying to negotiate the highest value when you're raising capital. And so when you ask the question, what are 409As used for? They should almost always be used exclusively for tax reporting and or GAAP reporting. And to the extent they help an investor get comfortable that you've got your books and records in order and you don't have an undue sort of tax exposure that could blow up their investment 5 years from now, that's where it should stop. What it shouldn't be used for is to help solicit investment, because it is, as I suggested, a very different instrument or document intended most of the time to be a lower value. It is exclusively for the value of one common share. It is not intended to explicitly opine on the value of the company or any preferred class. And you're at odds right out of the gate. You're usually at odds with the goal of the exercise when you're using it to report for IRS purposes versus try to get the best deal on a capital raising side. So that's often one of the nuances. I hear folks saying, can you do me a 409A? I'm looking to raise capital. And I said, well, are you really looking for a 409A then? Or are you actually looking for perhaps a synergistic level of value, that knowing this specific investor's background, pointing out to them all the things that your company could do to complement their existing company or their portfolio, and say, hey, look, you can use my compound as a secondary compound to your compound if you're doing pharmaceuticals, and together they could be a really good synergistic asset, and so forth. Or if you've got client bases that are similar, but you can now enter in with a new product, that could be another synergistic angle that you play as you're looking to raise capital. So there's just really fundamentally different exercises, and so something to keep in mind when you use it. Use a 409A for a capital raising discussion.
Yeah, and just to add to that, Greg, I think from the investment perspective, I think one of the main things that we look at 409As for is, again, in relation to how incented the important and key employees are of the business, because obviously when you're looking to put capital in to fund operating losses, most likely for the future, you want to make sure that you're backing a team that incented. And there are two pieces to that in my mind. One is just the number of options, right, and looking at how that is spread across the different key leadership to make sure that the important people we feel like are appropriately vested in the success of the business and then appropriately incented to stay and be a retained employee at the business. And the other piece of that is, what is the strike price, right? And how does that relate to the benefit stream of a potential sale transaction, right? And that, I think, goes back to where we started the discussion around the complex capital structure and the terms that could be associated with these different share classes. If you don't capitalize the business and fundraise the business in a way to, properly incent employees and retain them, then that's certainly a consideration that we look for on the investment side and plays into our decision making on how we would apply a valuation to a new fundraise. Right. So it's certainly more than just a number, I would say is my summary of valuation. Lots of different considerations, lots of different methodologies, and again, lots of different use cases ultimately for why we go through this process.
Right. One area of hot topic that everybody's talking about is COVID-19. I heard there was a pandemic going on, like something about a pandemic. I don't know. I think we've heard enough about it on the radio or wherever you get your news. COVID-19, I'd be lying if I said I knew where it was going. I'd be lying if I said I knew definitively how it would impact every valuation. Understand intuitively, COVID is helping and hurting many different businesses. Healthcare tends to be a little bit better, but it's not a blanket statement. And by better, in some cases, actually higher valuations. But it depends really where you're servicing. At the end of the day, capital is constrained. That has a healthy correlation to valuations. Debt is very cheap right now because interest rates are very low. You've got a lot of venture investors who have, what they'll call dry powder, so a lot of cash. But I'm seeing, and you might be able to talk to this better, Kurt, I'm seeing a lot more venture folks being a bit more in preservation mode of their capital, because if their existing investments are going to need infusions, they don't want to go and start picking up 4 or 5 new investments and then let their old investments have no cash available. So a lot of folks I'm seeing and hearing are really preserving capital and making it such that access to capital, even with very low rates, is starting to absolutely get constrained.
Yeah.
Is that what you're seeing too,
I think that, yes, we're definitely seeing that. I would also say it's, overall a mixed bag, right? I think it depends on, again, the investment firm. It depends on the sectors they're focused on. There are some sectors that are actually heating up as a result of this. I mean, numerous ones within healthcare. I think the obvious examples are, just the rapid acceptance of telemedicine, which is something that we've been waiting to see for quite some time. The rapid acceptance of some alternative delivery models in healthcare that are more home-based. You can see those businesses actually accelerating through this crisis and actually seeing their product market fit being strengthened as a result. But then there are equally, many businesses that are negatively impacted. So it's truly a case-by-case basis. On the valuation piece, I think the rule of thumb that we've seen in going through previous economic crises or macroeconomic changes is that typically the private markets lag the public markets from a valuation perspective by a few quarters. So we have yet to see a significant impact on kind of private market valuations, but could be something that we see a quarter or two from now. Elizabeth, I think we're probably at the time to take some questions. Should I turn it over to you?
Please. Thank you, Kurt. Thank you, Greg. Certainly gave a great overview of valuations, 409A specifically. And we have several questions. It looks like Greg covered the COVID question, which certainly came up as how that is impacting the environment. So Mark Alexander had a couple thoughts. Looks like he is right in the middle of his Series A. So he talked about, if you're launching a company and have spent years building the technology and have strategic partners, but no realized revenue, what are the key attributes you need for a fair valuation? Greg, do you want to answer that?
Sure. Yeah. I mean, it's very common, right? This type of fact pattern is, there's a lot of, particularly in the healthcare space, depending what you're trying to do, there's a lot of companies that you need to invest many years, many dollars to get to a point where it's a viable revenue generating enterprise. So, the way that you would look at it is management is huge at that point. I think Kurt will probably echo that. Management, they talk about real estate being location, location, location. Management is really a fundamental part of an early stage company. Someone who's done it before, someone who has, kind of clearly thought through the business model, thought through the target market, thought through the competitive landscape, the amount of capital they would need to get to market and get to cash flow positive. Those are important elements. Setting the tone for realistic expectations with the investor are all important elements. In terms of getting to a value, it is a difficult element at that stage because you don't have the traditional metrics of positive cash flow, let alone revenue, to value the enterprise out of. So what we do from a practical standpoint, because we're in the business of documenting valuations a lot of the time for the IRS, is we would spend a lot of time figuring out a bottoms-up forecast and think, okay, stage, how much have you spent? How much do you think you're going to spend? How do you, what's your target market? How many people have that ailment, if that's what you're after? What is your price points? How did you support that price points? What's the, market penetration over time? How many people do you need to do that? So a really well thought out business model that walks you through the top to the bottom of the income statement. And then one step further, you look at your capital expenditure needs. If you're going to build out a plant or if you need to fund working capital. So, for every 10 million of sales, I need to cough up another 2 million just to keep receivables going, for example. So there's all these elements around cash flow. If you've got a model that is relatively well thought through on that front, I guarantee you're going to be in a much better position to talk intelligently to get a nice valuation on your enterprise. I guarantee you that forecast is not going to come to fruition because no one ever, for even someone like myself, we never get our forecasts right. But the fact that you've thought through the elements is a big part of that management equation. It just says, look, this guy's really thought it through. They know how to go to market. They also have an exit strategy in place. So if I'm coughing up, $2 million to come into your enterprise, I know 5 years from now the strategy to get out. A lot of entrepreneurs don't think like that, particularly founders who are planning to be at it for a long time. The investors, they've got a monetary consideration. So you got to speak to that language, I think, to attract the capital and to get the best valuation.
Kurt, do you want to add anything on that, or it seems like he covered that pretty well?
I think it's just want to make sure we get to other questions, so I'll be brief, but I think it is again a common thing, which I think Greg mentioned. I think, again, having a well thought out plan creation. So one of the things that we like to push our management teams towards is thinking about milestone-based financings, right? Particularly at the early stage, not overcapitalizing the business. We've seen lots of examples where you take in a lot of money, and at that stage, the valuation is typically driven by a dilution equation. So less so in close concert with your potential market and what expect those financials to look like, and much more focused on, okay, how much of my business do I want to own going forward if I raise X amount of money, right? And I think where you can get in trouble is if those two approaches become misaligned, right? If you raise too much money at a higher valuation, that then you're not able to actually use that money to drive value on the financial side. That's where you get into more difficult situations down the road. So I would just advise to definitely think about things pretty holistically and think about things from different angles to make sure that you capitalize the business in the right way.
Great points. Absolutely. I like that holistic approach, pretty much in everything, in particular with healthcare right now, and the different elements and factors that are playing into what's needed in innovation. So that's great. Charles had a question: where can one find comparables for private transactions in investment? Kurt, do you want to take that one?
Yeah. So there are databases. Admittedly, the very fact that these are private transactions means that typically the data is not available, right? This is not something that companies often disclose, right? So there's that caveat. But there are some interesting approaches that companies are beginning to take around gathering this type of data and then applying it through various kind of predictive techniques. I would say what we use most often is the PitchBook platform, which does some of that work. And then also using the public markets as a proxy is another thing but it's definitely an art, right, of trying to gather that information.
Yeah, so to add to that, the three that I'm aware of, there must be a couple others, or four, I guess. There's MergerStat, PitchBook, Capital IQ, and Bloomberg, all of which are going to set you back close to $10,000 just to have a subscription. So not usually viable for an early stage company. You're going to pay a lot less just getting a firm to actually conduct your valuation. They have those tools, and they'll leverage those tools, to incorporate into your valuation. And even still, even if you did have access, maybe you've got a kid that's at, UMass Lowell, and they have access to a Cap IQ or Bloomberg terminal, and you say, hey, can you just run a couple of screens for me free of charge? That data is really hard to interpret. Even if you get multiples, which is hard to get, you don't know what's in them. Most of the time, these deals have all kinds of contingencies. I'm going to pay you $10 million today. I'm going to pay you another 5 when you hit this milestone. I'm going to pay you another 15 when you hit that milestone. There's a clawback if you, don't, get this many sales or this many, target market penetration by this date. There's any number of nuances in deal structure that makes it almost impossible to use the full deal document and all the terms and conditions, the flow of funds and so forth. So they're very hard to interpret. We often don't use them, frankly. We look at them to see if there's anything that we can derive out of it, but oftentimes they're very hard to interpret.
Great, very helpful, both of you. Okay, we've got time. We'll take this last question from Brian Glaster. Are there guidelines for early stage companies who can't afford a 409A in terms of setting strike prices? Greg, do you want to start with that one?
Yes. So understand that 409A, if we're talking about it in the literal sense, is the IRS code reference. And the goal of getting an outside party is to fall under a safe harbor. Outside party valuation is to fall under a safe harbor, so that you basically are absolving, as a business owner, you're absolving yourself the exposure, so to speak, to the IRS. Understanding that if you can't afford or don't feel like it's worth paying the money to get an outside valuation, you are taking on the risk for yourself, but that's fine as long as you're issuing options that are very clearly out of the money. So if common is worth $2, let's say you know that to be a fact, and you issue options at $4 all day long, the IRS isn't going to give you a hard time. It's the moment you issue them at $1 when they're worth $2, that's when you're in trouble. So if you set an arbitrarily high strike price on options, you definitely won't have issues with the IRS. Conversely, you're not going to get a lot of incentive to your employees if you're pricing them too far out of the money. So that's a high level. I don't know if Brian has heard of the anecdotal sort of rules of thumb out there, but I warn anyone in using this notion of a rule of thumb where common should be 30% of the recent preferred round is sometimes the kind of rule of thumb I hear. Every single time we see it, it's way off base because it all depends on your cap structure. It depends on the terms of the financing round, the magnitude, the conversion features, the participation rights, the dividend rights, all that stuff plays into the proper valuation. And you may be way off base by using some sort of rule of thumb. So it is a challenge. But if you want to call a practitioner, us or anyone else for that matter, I guarantee you they could give you a few tips specific to your case. Usually free of charge if you just pick up the phone.
Helpful tip. Kurt, do you want to throw anything else onto that piece?
That was covered well. Thanks, Greg.
Yeah, the rule of thumbs. Okay, well, Kurt, Greg, do you have any parting words as we close up this Lunch and Learn today?
I'm just
Greg,
glad I'm glad to have been asked to present here. I hope folks found it useful. It's tough to cover a lot of really nuanced stuff in a short amount of time, but hopefully there were some nuggets here that folks took to be useful. So thank you.
Yeah, likewise, and thanks, Greg, and thanks everyone for joining. I would say, valuations are complex and they're not just a number. So that would be my parting words to the entrepreneurs in the group. And definitely happy to help as people think about raising capital and setting their business up for success.
Perfect. Well, thank you, Kurt and Greg, for sharing your extensive expertise and knowledge today with all of us. Thanks to the audience for joining, for calling in, and doing the work in healthcare and innovation and startups and entrepreneurial work that were represented on the call today. We have recorded this session. We'll send up a follow-up email that will include a link. Greg did also include a great flyer that we'll attach and share with all of you, as well as each of their company information. So thank you again for being part of today's Lunch and Learn. Do check out Cambia Grove's full list of virtual events and consider being part of the Cambia Grove for our new membership program. So just visit cambiagrove.com for all the events. And thank you again. Have a great afternoon.
Thanks.
Thanks, everybody.
Bye.